Boom! Live here we are. It's What Say You with Progress Realty Partners coming at you guys live from our broadcast studios here in Tinton Falls, New Jersey, aka our office. Guys, I'm Dan Salonis, joined by my partner in crime, Adam Dickert.
That is right.
And we get questions every week from investors asking us our opinions on different situations, asking us different thoughts on commercial real estate investing topics. And don't forget, if you're interested in investing in commercial real estate, you can become a direct owner of a property, get dependable cash flow, and remain 100% passive by partnering with us, Progress Realty Partners. Check out our website, prp.us. But Adam, we got 4 questions today, big dog.
That's what I heard, man.
Yeah, we got 4 questions, 2 for me, 2 for you. And let's jump right into this thing because I tell you what, it's a 11:45 and my stomach's already growling.
I'm starting to get the shakies.
Yeah, shakies are coming in. And brain function diminishes the more I get hungry. So
lay it on me.
Let's get right at this thing. I know we got John from New York. He wants to know, he says, most of my experience has been in multifamily investing. Is it possible to be diversified while still buying real estate? So, Adam, what say you?
Pretty good question. You know, a lot of guys kind of start out in multifamily. It seems to be the natural path. People just understand it. Very, very bluntly, yes. So you have to realize, diversification is a lot more than just different asset types, right? You can have different types of multifamily. You can have Section 8 housing. You can have luxury units. You can have mixed use, which is kind of like a hybrid. Maybe you have some retail on the bottom floor, or maybe some office, and then some either office or retail. Office or multifamily above it. There's all different types of diversification. People don't need to. You don't need to buy one multifamily building, one industrial building, one retail asset. Multifamily in itself can be very diversified. Think about the areas you're buying in, right? Don't only buy in one city. Right? Some people make a bloody fortune doing that. They gobble up everything in one specific city. They're the go-to guys for that asset type in that area. But you can definitely diversify. Buy different types of multifamily, different types of unit mixes, maybe throw some mixed use in there, buy in slightly different areas. Let's say one city booms or busts. You don't want to have all your eggs in one basket.
Yeah, good point. And our buddy Alex Reisner is
very distracting.
Peppering in the questions. What up, Allie boy? Allie's asking, can I invest my 401k into real estate? And yes, you can, Allie, if it's self-directed. 401k, IRA, cash. We like the cold hard cash too. 1031 exchange, another good one. And what's a cap rate mean? I know he knows this answer. He just likes to give us some softballs. So yeah, cap rate, NOI divided by a purchase price, that gives you your cap rate, your capitalization rate. Basically, that's the percentage return you would get if you bought the property all cash, right? So no debt, you're not leveraging it. Cap rate is the return you're going to get on your money should you buy a property all cash. So Allie, thanks for that. Thanks for warming us up there. Yeah. Appreciate that, bud. We got here? Andrew.
Here we go. I'm giving the old lob over here. Andrew from Jersey. Mr. Daniel, when looking to invest in a property, what do you care about more? Cash on cash return or IRR? What say you?
Yeah, good question. It really comes down to what, the individual investor and what they're looking to achieve. The one thing I would say is that, cash on cash, nothing beats getting cash in your pocket. Right? IRR, internal rate of return, there's a lot of assumptions involved. And, the exit cap rate is one of them. IRR can be easily manipulated by anyone, who wants to just show higher returns. You can't really so much as equally manipulate cash on cash return because, more often than not, it's based on in-place income or it could be, based on projected future incomes. But there's a lot of variables when it comes to IRR that really is up to whoever creates the model, right? Whoever does the analysis, they can manipulate the IRR. If I'm looking at a deal, if I'm a passive investor, right? I'm an LP that's looking to partake in someone else's deal. I'm looking at the IRR, but I'm looking at the exit cap rate that's associated with that. And to me, you're better off looking at the cash on cash return, because that's money in your pocket. People can't really predict what's going to happen 10 years from now, where cap rates are going to be, interest rates. It's a little bit more easily predictable what the cash on cash return is going to be. And I think that's a more dependable number. So I'm all about the cash flow.
You even take one step back. I mean, you said that you like looking at the exit cap rates, right? I mean, we happen to do this, I guess, a little differently than most other groups, but why is it so important? Well, I mean, one, you can't predict cap rates, but why is it so important to really pay attention to that?
What, the IRR?
No, the exit cap rate.
Oh, because like I said, I mean, you can make, if you buy a property, let's say at a group showing they're buying the property at a 7 cap, just for example purposes. If they want to boost that IRR, that percentage, and make the return seem higher, I mean, they could throw an exit cap rate at a 4 cap rate if they wanted to, and that'll make the IRR look really nice. But what are the chances you're going to get a 4 cap when you sell that property? Right? Depends on what it is, but I would say odds are probably not going to happen. So it's a return metric that can be easily manipulated to make a deal appear better than it is. So that's why, for my money, I like the cash on cash return, and I just like to know that I'm getting cash flow in every year.
Right. It also means like how hard your money is working for you, right? You put in $100, if you're getting a 10% cash on cash, that money's working pretty hard for you, making 10% of your money.
Yeah, exactly. What else is
a quick shout out? My cousin Alan is on here talking about this beautiful picture over here.
What's up, Alan?
He's texting me. Do you like this? Hope you like this painting. This is for you, Alan.
Good question, Allie. Do you guys do cost segregation on all your properties? Yes, we do. Guys, if you're not doing a cost segregation analysis, definitely look into it. Definitely look into it. Yeah. Everyone knows depreciation is a great kind of phantom expense you could write off against your income, right? When you depreciate assets, cost segregation helps you speed up that depreciation and actually compartmentalizes the different components of a property and gives it its own depreciation schedule. So instead of 39.5 years for commercial, 27.5 for multifamily, you might depreciate the roof over 10 years, the HVAC units over 5, carpets over 3.
Why is that important, though? Why is that important? Obviously, it sounds good. Why is it important?
Yeah, because it's sheltering more of your taxable income. So the higher your depreciable amount is, the lower the amount that you're showing as a gain on paper from an income tax standpoint. So if you're able to speed up your depreciation or compartmentalize some of these things with a cost seg study, you actually get more depreciation in the early years, and you're sheltering more income, or even potentially showing a loss on a property that you may otherwise actually be receiving cash flow from. So yeah, cost segregation analysis, really great tool. Definitely something everyone should look into.
Huge benefit.
Alan, what's up, Alan? Thanks, pal.
Oh my God.
All right, we got Gabe from New Jersey, Adam.
Where?
He's coming, I think. He wants to know, I'll ask you in the meantime. He said, what are your thoughts about buying in markets, away from markets where you live?
That's the question?
That's the question. What are your thoughts on buying in markets that are away from where you live?
Totally for it. There you go. Totally for it for the right reasons, right? If you're in a New York City, or we're in Jersey, right? Let's just use Jersey. Extremely tight pricing, very high, very, very low cap rate. So, why are we going to pay $8 million for a $5 million building, right? Some people have a very, very low cost of capital, meaning they only need to make 2 or 3 or 4% on their money every year. Groups like pension funds, sometimes insurance companies. But the average investor, other institutions, they need to make money, right? They need to give money back to their partners, their investors. So I mean, totally for it. But don't forget, real estate's a local business, right? So we're in New Jersey. We have properties across the country. Let's use North Carolina because it's a great example. We have a 220,000 square foot shopping center down there. There's 17 tenants. You have guys like Lidl, Planet Fitness, Gander Outdoor. We have a property management company that their job is to go there every single day, check on the property, make sure something as simple as the garbage is picked up, the landscaping is in tip-top shape, making sure the tenants know that they're present and that somebody physically direct relationship to the owners, have eyes on the property every single day. right? Real estate's a local business. So if you have the capability to go across country, feel comfortable hiring a third-party property manager, getting all your vendors in check. And even, we go out to our properties every single quarter. We go out to all of our properties. I mean, it's very important to physically have eyes on it. So if you can get around and wrap your hands around having all these things in place, doing it from afar, counting, property management, the whole nine, I think it's well worth it, especially for yield purposes. Go to secondary and tertiary markets. You don't need to go to the Arizonas and strictly the Carolinas like everyone else is going to, or flocking to Texas or Florida. There's a lot of good markets out there. You can get a lot better yield than the Northeast, for instance. If you can manage all that, definitely do it.
Yeah, agreed. And I mean, some of those other markets too, like Columbus, Ohio, Cleveland, Ohio.
Sleeper markets, dude. You can make a lot of money over there for the same. You put in $10 million there, $10 million in North Jersey. It's only an 8-hour drive. You should probably make it in 6 with your PBA card.
Yeah, right. But I agree with what you're saying. I think what's like an important factor too is how large is the property? How much income does it produce? Because depending on the size of it, if you're looking at a small property that doesn't really throw off a lot of income, it may not make enough money to pay to have a property management company oversee it. And if that's the case, if you have to be the one that's managing it and it's more than a 2-hour drive away from you, that might be difficult. So I think if you're looking at a large enough property that because of the rents that are coming in, it produces enough income that you can withstand having a property management company, because it's all economies of scale, right? The more money the property makes, the more professional help you can hire, right? The better systems and process you can have, and the less work you have to do on your own. So just a important little tidbit.
Yeah, I left out probably like one of the most important parts, financial aspect.
I thought everything else was good. All right, we got Blake from South Carolina.
Oh, this guy wrote a book.
Oy.
He's interested in buying a property not far from his house. The current owner believes he can increase rents. So do I. Blake, meaning so do I, not me. I don't know what the hell this thing is. And his asking price is based on getting those rent increases. Should he pay a higher asking price since he knows he can increase rents?
So I'll answer this by actually giving an example to Blake. Blake, if Apple were trading at $100 and an analyst went on to MSNBC and put his target price to 120, would you pay 120 right then and there because you believe it's going to go to 120? It doesn't make any sense, right?
What if it goes to 150 after that? Right.
Well, so we think about from like a stock comparison perspective, you would never pay more than what the stock is currently worth. And at the end of the day, I mean, we'll never pay more for a property just because of potential income that might come in the future, right? Because that's how once you start doing things like that, that totally gets away from the philosophy of making your money on the buy. Right. And that's the most important thing. Again, you may collect your proceeds when you sell your property or you refinance your property, whatever the case is. But you make no mistake about it. You make your money on the buy. The negotiation is everything. So if you wouldn't pay 120 for Apple if it's trading at 100, why would you pay $1 million for a property if it's only worth 750? So that's the comparison I would give. I would never pay for pro forma income or anything. If those rental increases are as achievable as the owner in this case is saying they are, why hasn't he done the increases?
Exactly. Why isn't it in place?
Right? Like, why isn't that what the rents are? So I would be careful because you start buying properties based on rent that you think you can get in the future. I mean, you're just opening the doors to a hell of a lot of trouble and headaches and frustration. So always make your money on the buy.
Even like on the complete same topic, but a flip side, right? Let's say your expenses are $100,000 and the seller's saying you can get these expenses down to 50. Are you going to take his word for it and say, wow, you know what? Let me underwrite this on a lower expense ratio? Hell no. Why aren't his expenses lower? You want to buy on existing current income.
Yeah, exactly. If the expenses could be lower, he would have gotten them lower in a lot of cases. Yeah. All right. Hey, I give us 7 out of 10 stars today. What do you think?
It's going to go 8.25.
Ooh, 8.25. I'll take 8.25.
8.25.
Guys,
Also, because I'm really, really hungry.
woo! That was What Say You with Progress Realty Partners, guys. And don't forget, if you have any interest in investing in commercial real estate where you're a direct owner of the property, you benefit from the depreciation, you get dependable cash flow, but you can remain 100% passive so you can hang out with your family, ignore your family, do whatever you want to do in life. You do
Hang out with
you.
us. Hang out with us.
Hang out with us. We like hanging out. You do you. We'll do the real estate. Visit our website, Progress Realty Partners, prp.us. But that was it, guys. I'm Dan Salonis.
I'm Adam Dickert. Thanks for watching.
Thanks for watching. See you next week.
Thanks for watching.